Welcome to this explainer. Okay, picture this. It's June 24, 2026, and the atmosphere on Wall Street right now is, well, it's absolutely electric. We are staring down what's arguably the highly anticipated main event for the entire market. It's one of those rare moments that has trading desks incredibly tense and just fully dialed in.
Okay, let's dive into this with a massive, high-stakes question. Can one single earnings report really erase $2 trillion in market value? I know, it sounds kind of impossible, right? Like a wild exaggeration or some sensational clickbait headline just meant to grab your attention.
But the answer is a resounding yes. Welcome to the Micron stress test. The truth is, even if you don't own a single share of Micron directly in your own personal portfolio, you are sitting right in the blast radius of this report. Because of how heavily weighted technology and semiconductor stocks are in standard index funds, mutual funds, and, everyday 401ks, a shockwave here ripples straight into your retirement accounts.
Now, what's really interesting about this slide is how we define AI infrastructure demand. We're talking about the critical need for memory chips, cloud computing, and the massive data center expansion that actually powers artificial intelligence. Why is this specific company the gold standard here? Well, it all comes down to the hardware. AI, specifically those massive processors made by companies like NVIDIA, needs incredibly fast memory to actually function. We're talking about high bandwidth memory, or HBM. And Micron? They're one of the very few companies on the planet capable of manufacturing these specialized, high-capacity memory chips at scale. They aren't just making generic computer parts. They are the fundamental bottleneck and the ultimate indicator of whether this explosive AI demand is really continuing.
Section 1. The AI Bellwether. Why one company matters.
Micron is no longer just a business reporting its quarterly sales. It's transformed into a critical test of whether this massive AI-driven bull market still has strong, undeniable momentum behind it. Which brings us right back to today, June 24, 2026. Every institutional investor, every retail trader, literally anyone with a stake in tech is hyper-focused on this specific earnings report. They aren't just looking at past revenue, right? They're obsessively dissecting the forward guidance and profit margins. Are tech giants still buying these HBM chips by the truckload? Are margins holding up? Or is pricing power slipping? This specific data drop is going to set the trajectory for the entire tech sector.
Let's move to Section 2, the bull case, the boom, and see how this builds.
So what happens if things go incredibly well and Micron absolutely crushes expectations? Well, if they deliver strong earnings and optimistic forward guidance, which essentially confirms that cloud providers and tech behemoths are still locked in this arms race for AI infrastructure, the market is going to interpret that as a massive flashing green light. It confirms that AI spending remains incredibly robust. If that happens, and the supply-demand imbalance for memory chips remains tight, we could see Micron shares potentially rally anywhere from 10 to 20%. Maybe even more, as institutional money just piles back in to capture that upside.
And, that enthusiasm wouldn't just stay isolated to one ticker symbol. A strong report would act as ecosystem contagion, but in the best way possible. It'd likely reignite enthusiasm across the whole semiconductor sector, lifting all boats. When the company making the memory chips says business is booming, it inherently means the companies making the GPUs and building the data centers are booming too. This pushes a massive wave of capital back into AI leaders. In fact, bullish investors are projecting that leading AI-related momentum stocks could be targeted right back up to the $1,300 range. That could potentially drive the broader market indices toward brand new all-time highs.
Section 3. The bear case, the doom.
And this brilliantly illustrates the flip side. The bigger risk right now might actually lie on the downside. If they miss expectations or give weak guidance, showing that AI-related demand is even slightly slowing down, the reaction could be incredibly severe. We're dealing with a terrifying gap here. On one hand, you have that euphoric $1,300 bull target. On the other, if the report disappoints and the narrative breaks, some traders believe leading AI and semiconductor names could fall all the way down to the $850 or even $750 range. That is a massive, incredibly sharp correction from recent highs. We're talking about billions of dollars in lost equity almost instantly.
So how exactly do we get there? It's a rapid, violent domino effect. Step 1. A disappointing report hits the wire. That signals the AI boom might be decelerating. Step 2. We see an aggressive repricing of growth expectations across the entire market as analysts scramble to downgrade their models. And Step 3, well, this is where it gets truly dangerous. Because so many investors are heavily concentrated in these stocks, and leverage levels, meaning borrowed money used to buy shares, are dangerously high among active traders, a sudden price drop triggers margin calls.
Think of a margin call like a broker demanding immediate repayment on a loan because your collateral, your stock, just tanked in value. If traders don't have the cash, the broker automatically sells their shares to cover the debt. These forced liquidations hit the open market. That drives the price down further, which triggers even more margin calls. The fear-driven selling just accelerates exponentially.
This localized panic wouldn't just be isolated to the tech sector either. A broad semiconductor sell-off of that magnitude acts as an incredibly heavy anchor, potentially pulling the entire overall market down by 3 to 4%. To put that into perspective, a 3 to 4% drop in the major indices from a single catalyst is absolutely immense. We usually only see that kind of rapid, broad market destruction during unexpected geopolitical shocks or systemic failures, not from a single corporate update. It really highlights just how top-heavy the current market structure actually is. So the crucial point is the sheer scale of the potential damage. -$2 trillion. Just let that number sink in for a second. That is the amount of market value that could be completely erased in a very short period if this bearish scenario plays out. To contextualize $2 trillion, you're talking about wiping out a value roughly equivalent to the entire gross domestic product of countries like Canada or Italy, just gone in a matter of days. It is a jaw-dropping amount of global wealth hanging entirely in the balance of this one moment. Which brings us to Section 4, the real-world stress test, beyond the balance sheet.
Because, as we've established, this earnings report is about so much more than just one company's financials. We really have to zoom out and look at the macro-level impact. What exactly is being stress-tested today? First, the entire AI investment narrative is on trial. The market has priced in a multi-year, uninterrupted boom. Any crack in that story forces a total rethink. Second, semiconductor valuations. These companies are trading at massive premiums based entirely on future growth. If that growth slows, those valuations are no longer justified. Third, institutional positioning. Hedge funds and asset managers are heavily overweight in tech right now. If they all rush for the exit simultaneously, market liquidity completely dries up. Fourth, retail investor confidence. They've been riding the coattails of this momentum, and they could be severely shaken. And finally, that leverage and margin exposure we discussed earlier. This single report is effectively a massive referendum on the structural integrity of the entire financial ecosystem.
And here is the reality of the current mood on Wall Street. Because of crowded positioning, fear is currently slightly outweighing optimism. Right now, investor portfolios are extremely crowded in AI and semiconductor stocks. Everyone is essentially standing on the exact same side of the boat. The danger here is that expectations are sky high. It's kind of like a crowded theater where everyone is enjoying the show, but there's only one very small exit. If someone even whispers the word fire, or in this case, slowing demand, the rush for that door is going to be brutal. When expectations become this elevated, even good, solid results might not be enough to satisfy a market that is priced for absolute, flawless perfection.
Section 5. Trillions on the line. We are at peak tension right now, because the market's reaction to this specific event isn't just a daily blip. It's going to set the tone for the remainder of the week, and very realistically, it could dictate the trend for the entire summer. It really boils down to this perfectly captured thought from our source material. One earnings report, one sector, trillions of dollars watching. That is an incredible, almost unprecedented concentration of risk placed squarely on the shoulders of one single corporate update.
Now, before we wrap up, it's vital to present this disclaimer as context for the intense market speculation we just explored. The price targets we discussed, both the $1,300 bullish scenario and the $850 to $750 bearish scenario, along with market decline estimates and valuation impacts, are personal market opinions and hypothetical scenarios. They are not investment advice or forecasts.
So, as we watch the numbers roll in, I want to leave you with this final critical question. Will Micron confirm the AI growth story, or reveal cracks beneath the surface? The answer is going to redefine the market landscape. Thank you so much for joining me for this explainer, and keep your eyes on the data.